So, Melissa, you were saying your maiden name is McDowell.
My, my maiden name is McDowell. Yeah. I think Brooks and I might be like, some sort of crazy historical lineage that we don't know
Third,
about.
third cousins or something, maybe
I
fourth
don't
or
know.
fifth.
Fourth, fifth, second removed. I
Yeah,
don't know. You know where I was probably the removed part that kicked me out for something. I'm sure. Oh my
Do you
gosh.
spell it the same? MCD?
Yeah, yeah. And funny thing is, I didn't have a single person ask me how to spell McDowell. But inevitably, when I chose to be a Langdale, I get asked it probably, I don't know, 3 times a week. It's just
wow.
the craziest thing to me. People want to say Longdale or they want to put an S in it, Langsdale.
So
And
you did a lot of Melissa McDonald because I did a lot of Brooks McDonald.
I did get a McDonald every now and again, but it was really rare.
I get
Maybe
more of that
South
than
Carolina
yeah,
thing. Maybe there's just
yeah,
more there.
maybe yeah.
I don't know. Well, speaking of funny things, Rob, in your commentary this week, you had a funny video about inflation where, for those of you that have not seen this, it's actually hilarious. There's a lady in Costco that is like, physically in pain because she's got this reaction to everything that's going through the checkout line in the grocery store.
Yeah, I don't even think it's a Costco. I think it's just a regular supermarket. But yeah, I mean the prices that are getting rung up, and he's treating her like he's a paramedic. You know, keep your eyes on me. Keep your eyes on me. Steady, steady. You know, and here, bite down on this, and he hands her that divider between the customers and the on the conveyor belt. Bite down on this. Stay with me. Stay with me. Anyway, it is funny. It's funny, but it's because it's true, unfortunately. So inflation is tough. I say I don't know how some families do it. You move to cheaper alternatives, store brand items, and once you get past that, I know it's just it's tough. Family of four kind of thing. It would be very difficult.
I have a little PTSD from grocery store experiences, I'm not gonna lie. But I'll share with you just so y'all don't think I'm super weird, and then we'll totally kick this off and talk about marriage. When I have twin boys, for those of you that don't know, my boys are 12 now, so I have recovered a little bit. But when they were little, we had this stroller called the Langdale limo. It was like both of the little, they're not car seats, but they could be, I guess, the little carriers that you have like side by side. And we would go through all the aisles. I mean, it literally would take us like 3 hours to grocery shop. And it was the most crazy experience for us because we only had 3 hours because then they had to eat again, right? So it was like you had to time everything just perfectly. So this is why I don't go to the grocery store anymore. I could totally relate to the lady as she was going through the checkout. So y'all can all think I'm
So you have your staff go to the grocery store instead. Is that?
no,
I
there's an
mean, you
app
have to
for that.
eat.
There's an app for that. There's an app for everything. I do
There's
all
an
my
app for
grocery
everything.
shopping on an app, and then I pull up to the grocery store and they put it in the back of my car, and then I go home. It's lovely.
We're
You're
in
so
St. Louis, so
technologically
don't
advanced.
feel bad
I
about
hear
it.
there's. Yeah, exactly. Anyway, all right,
All right,
let's
all
talk
right, all
about
right.
mortgages.
We have to talk about mortgage now. Can I kick us off? Is that okay, Rob? Okay.
Please do.
All right, welcome everybody to the rundown. Melissa Langdale, the president and CEO of Mortgage Collaborative. We're excited to have you guys all here. As always, I'm joined by Rob Chrisman. And this week we have a very special guest, Brooks McDowell, who apparently I am some sort of historically lineage tied to. But Brooks is the SVP, the Director of Secondary Marketing for Premier Bank. Brooks, thanks for joining us today.
Thanks for having me.
Yeah, I'm excited. We got some fun things to talk about. And for those of you that don't subscribe to us on YouTube or our podcast channel, please make sure that you do. But let's go ahead and get things kicked off with just learning a little bit about Premier Bank. I'd love to hear just a little bit about why we're different, why you're, what kind of sets you apart in your markets.
That's right. But Brooks, just so you know, what Melissa's looking for here is if there are vendors on the call, if they if they contact you, how are they gonna, what angle are they gonna
What
work to
angle? Where are they coming from? Hey, I heard you did this. Hey, I heard you talking
right,
about that.
right.
That was not on
Understood.
point, but
Understood.
okay.
Well, I appreciate, teeing it up for me there, Melissa. Thank you. Thanks for having me. Premier Bank, we're a little bit of a newer institution, although we're a combination of two older institutions. We started in 2020. We were the merger of Home Savings Bank, which I came from, and First Federal Bank of the Midwest, both two Ohio banks that merged literally about a month before COVID. So going through a merger during COVID is pretty interesting, especially when you're going through a refi boom. But we did it, and we're still here to talk about it. So I say if we could merge during a pandemic, then we could probably merge during anything. But two older institutions, two older Ohio banks, well over 100 years old. We originate in the Ohio markets. We also do some lending in PA, Michigan, Indiana, Kentucky as well, some of the surrounding states. We're a fairly big construction perm lender. In fact, depending on the seasonality or time of year, it's about 30 to 40% of our business overall. So,
Hi,
and it's been like that for the last 10
what are
years.
you
So
doing there?
Just
we do a
filming
lot of
this as a
construction
background.
perm. We do we're a depository, so we do a little bit of
Okay.
portfolio, and we sell to the agencies. We do our own servicing. We're just kind of like a community bank. We're a community bank, and very heavily involved in mortgage origination, construction perm lending, and that sort of thing. So very happy to talk about Premier and some other things today.
Well, speaking of community, I think Rob's making friends.
Yes.
Well, I should tell you where I am or where I wanted to be. I am in front of a place called Wild Care, where they bring in wild animals that have been injured or that are sick, and they care for them and then they set them back out into the wild. And it's a volunteer staff. So what you may see occasionally are volunteers going to and from caring for, possums and bald eagles and skunks and so forth. And I actually wanted to go inside and film. They do have a bald eagle here, and I wanted to have the bald eagle in the back, but they're having an outbreak of avian flu, and so non-volunteers are not allowed in there. It's not a good thing, but anyway, maybe some other time. Brooks, I wanted to ask you, every week, every day, I get dozens and dozens of emails from loan officers asking why is my secondary marketing group, messing with my pricing. No, I don't get dozens and dozens of emails every day asking
You
that,
probably do.
but occasionally, but you do, yeah. Stop messing with my pricing. Can you explain to the layperson, the slow at math kind of people like I am, how 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 a mortgage rate is set? How is pricing set? I talk a lot about it, and I do know something about it, but just for the
Yeah.
average person out there, can you go through the process?
Yeah, there's a misconception that, pricing set on based on how good or bad I'm feeling that day or my mood or, whatever else is going on, in my life. But no, it's a deliberate process, and it's something that, we put a lot of thought behind when we set pricing. It's kind of starts with our profit expectations and, where we think rates are at in the market, how much money we think we can make per loan, and really covering our back office costs. It's we have to kind of calculate what needs to go into this rate. How much do we need to get out of this rate before we set rates? It's not just we're not just looking around and seeing where the market's at. We're looking at our own internal costs and profit expectations and that sort of thing. We personally we use a pricing engine, so we get investor pricing fed directly into our pricing models every single day, and it's really just a math calculation of how much do we need to make, how much is our back office costs, and taking that, holding that back, so to speak, from our investor pricing. So just kind of using some examples, if we have a profit expectation that we want to make net 50 basis points, and our back office costs are 150 basis points, we know we have to take 2 points out of our investor pricing to essentially, that's where our rates are at. That's where we kind of want to start our rate. So, we're looking for, in that scenario, we're probably looking at a par rate around, the 102 handle or something like that. But it's a deliberate approach where we're going back, we're looking at our costs, we're looking at our profit expectations, we're doing it by product line. Even as detailed as we mentioned, we do a lot of construction perm. We sell those to the agencies. We're looking at things like, how long is it going to cost us to hold this loan for 10 months? Hold this loan on the books before we can deliver it to the agencies when the collateral is 100% complete. How much is it going to take to interest rate protect this loan for the next 10 to 12 months? We even go as far as, some loans on the construction market, you just can't deliver because, there's something that happens in the construction cycle, which makes it an undeliverable loan. We even go as far as, calculating that and how much fallout can we expect from our pricing from an undeliverable loan, or a loan we have to sell scratch and dent or something like that. So it's a very deliberate process. It's a very measured process. Now, I think some of the things that, where LOs kind of did a little weird is it's also a fluid process. So sometimes your best plans, you get into a market and you find out markets are tighter or maybe a little easier than where you expected. So, you're adjusting it as you go along, but it's a very deliberate and measured process, and a lot goes on behind the scenes. It's not as easy as just waking up and deciding what rate I want to, put on our rate sheet that day, sort of a thing. So there's a lot that goes into it, and it's something that's very calculated.
Yeah, I know that with banks especially, they're looking at their cost of funds. They're looking at their overhead. They're looking at obviously the loan level price adjustments that the agencies have. They're looking at their cost of warehouse, or their cost of deposits. The list goes on, and it's a very, very precise calculation typically when you are dealing with a bank, a depository bank, or a credit union, versus an independent mortgage bank. And independent mortgage banks tend to be more like, oh, you need an eighth to make the deal work, or a quarter. Yeah, we'll give you a price concession. And I think that doesn't happen as often at a bank, at a depository bank, because it is so precise. And you're right.
And that's,
oh, go ahead.
no, I was going to say that's a good point. What I kind of went over our originate to sell pricing, and typically we've always traditionally in the past, we would kind of index portfolio pricing, balance sheet pricing, something off of agency saleable market pricing. But it's become a little bit more complex than that, with cost of funds increasing and moving at different rates than mortgage rates, sort of a thing. It impacts your portfolio usage. So we would kind of calculate something and then portfolio maybe index it off a conventional rate or something like that. But it's become even a much more involved process today when you're considering deposit rates and cost of funds rates and balance sheet usage and capacity across the entire bank. There's a lot more that goes into pricing a portfolio loan even today than what it was, say, 24 months ago.
I want to pull on that a little bit because, obviously, as people start to expect rates to go down this year, whenever that's going to happen, there's lots of conversations around EPOs, for those loans that you sell, that has to be a consideration. The other side of it, though, is your portfolio, your life alone, adjustment is down. Like, so as you're looking at kind of revenue projected out for those loans, are you considering anything different for your portfolio loans to adjust for that kind of decreased life of loan expectancy over the next 18 months?
I would say, the one thing, premium pricing has sort of been a problem within the market over the last 18 months. I mean, if we kind of go back to 22, if you remember, a lot of rate sheets, you didn't see a rate above a 99 handle on a rate sheet, sort of a thing. And everyone was paying points to get a rate just because everyone was so afraid of prepayments that they wouldn't put any sort of premium pricing on a rate sheet. And we were a little bit the same. It's gotten a little bit better. There's been better liquidity in the market, and that's starting to subside a little bit. But I think, we're still, I would say leaning towards, charging points as opposed to premium pricing or par pricing, sort of a thing. Doing things that will reduce prepayment risk, whether it's a portfolio loan or whether it's a loan that we're selling into the secondary market, sort of a thing. We are we are using more points as opposed to premium pricing. We're combing portfolios. Even rates have moved down actually pretty quickly over the last couple of months, and we're even combing our pipeline to see if there's some rates that every once in a while lenders will kind of cap out. It doesn't matter how high your rate is, they're going to have a max price. So we're reducing some of those rates where just the rates are maybe not even available, ironically, in just a short period of time, or they can be at a lower rate at the same price, sort of a thing, just to reduce that EPO risk or that prepayment risk. Because the last thing we want to do is close a loan, sell a loan, thinking, hey, we made our money, and then all of a sudden that refis or pays off or whatever. The one thing I will say is it's still a little sobering when we're doing our servicing shocks how far rates need to drop to really see significant balance sheet prepayment risk. I think we're still farther away from shorter mortgage duration than what we've seen. But we've started to see those 7 and 8 handle rates that we originated in the middle part of this year are ripe for payoffs. So we're using those mitigating factors, and behind the scenes we also have some derivatives and things that we can use at a bank level. But it's really just kind of making sure we don't have too much premium pricing out there that we're at risk for prepayments, and combing our pipelines to make sure the rates that we're delivering have as little prepayment risk as possible.
Yeah, I always remind people, and I want to talk about competition here in a minute, because competition not only impacts lenders, but also, loan origination systems and hedging companies and credit reporting agencies and so on, because competition enters into pricing. But nobody, if I'm going out and buying IBM stock at 105 a share, I don't want to have to, have it go to $100 a share. If I'm an investor in mortgages and mortgage-backed securities, whole loans or the securities, I don't want to pay 103, 104, 105, 3, 4, 5 point premium and have the loan pay off, 6 months later, and I get par back. Hey, great. The borrower made their payments and there was no credit risk, but I paid 103 and I'm getting back par. So I just lost 3 points. So that tends to your point, make investors shy away from wanting to pay a premium in an environment of perceived rate reductions. So, but getting back to competition is one of those interesting things. And I'll tell a quick anecdote. When I was new to the business and I was setting prices for a mortgage lender, and the CEO, an owner who's actually still in business, would come in and he would throw the I think it was Icon. Was that Icon? I don't even know if Icon still exists. Does it still exist?
It's name change, but yeah. Mm-hmm.
Okay. They would fax out where you would pay to be on the service, and they would fax out where you were based on a $300,000 800 FICO, some kind of generic loan, and where you were in the ranking, and you throw it on my desk. And if we were anywhere below, like in the top 7, he'd say, look, I need to, you need to sharpen your pencil here. There was no conversation of cost. There was no conversation about overhead. There was no talk about, gee, Countrywide's up at the top, but their guarantee fees are so much lower than ours. Or some bank is at the top and their cost of funds is like near zero because that's what they're paying their depositors. And we're paying our warehouse banks, 8% or whatever it was. He would just want to be near the top, because he was a competitive person and he wanted to be near the top. And so I did, you do what you're told, right?
Yeah.
But all of that matters into it, and it's something that the capital market staffs of thousands of lenders have to deal with every day, is all of these factors. And it's very, very difficult.
I mentioned back office costs, and one of the good examples is, and why you just kind of can't put out rates, or why we're evaluating it, is unfortunately, part of what's happening in the market the last couple of years is we've seen layoffs, we've seen we're not, when you kind of do those back office cost analysis, you don't have as much production to spread those costs over, sort of a thing. So even our back office costs, when we've had some cost reductions, but just sort of a volume play, our kind of our variable costs, so to speak, has been increasing because we just don't have as much production to cover those costs across the board. So we've even seen back office costs increase by 25 basis points when we're kind of looking at it at a per unit scale, just because of sort of the origination and spreading those costs over per loan, sort of a thing. So that's kind of a silent killer because you're not really expecting it, but you're like, we just have less production to spread those costs over, and it impacts your margin. So you could be 20 basis points lighter on sold margin than what you thought, just because you're not paying attention to everything that goes into an originate and sell model, or any type of origination model.
Brooks, what did you do early on in the mortgage world? Did you immediately jump? Did you come up through the production ranks, or did you come up through the ops slash?
I came in through secondary. Actually, I started with Server Mortgage back in the early 2000s, basically right around the refi boom of 02, 03. Kind of just came in and was new to the industry, but came in secondary and kind of made my way up through the ranks. I've actually been with, as I mentioned, Premier Home Savings for the last 15 years. And I've held positions in loan servicing, sales, product development, construction, et cetera. But I really came in secondary, and I've been in secondary, my entire career.
So there aren't too many people who make a switch between, say, secondary marketing slash capital markets and going into production, or LOs or branch managers who decide, oh, I'd rather go into capital markets for a while. That there doesn't seem to be that, there's not that.
There's not a ton of, I will say this, my staff, my secondary staff, most of them, the majority of them, have very little mortgage background and very little secondary background. And in
Really?
fact, it's just kind of like, yeah. And I always looked at it as, if someone can do a job, we'll teach them and we'll get them in here. And kind of like me, I started without secondary experience. So I guess I kind of know how to come in without any sort of knowledge at all. And you can kind of turn it around, sort of a thing. But it is unique. I mean, sometimes, people start in processing or loan officer, and somehow, there's reductions and there's an open in secondary. So they end up in secondary by accident. But there's not a lot of crisscross, but it's a good way to understand understand the business as well, because you're kind of you're kind of the last stop before the loan leaves the at least the origination area, so to speak. And everything that goes into manufacturing a mortgage loan kind of comes down to the the sale at the end, if that's how you execute. So not a lot of crossover, but it's kind of a unique spot, but also a good spot to start.
I like the fact that secondary has a really a holistic view of, like you said, the loan manufacturing process, kind of everything that happens up at that point. You've got a really good sense of it, and you start to get a sense of where the if there are any kind of tweaks that need to be made, where they're at.
We're involved when the loan is locked, and we're involved, at the very beginning, and we're involved when the loan is sold at the very end. So, and we're obviously paying attention in between. So you kind of get the whole spectrum of the cycle.
Yeah. I wanted another kind of holistic thing that has hit our industry over the last, several weeks, but really, longer than that. First American, Mr. Cooper, now, kind of Loan Depot, this whole kind of cyber attack, cybersecurity issues that most companies, particularly banks, have been focused on for quite some time. So this isn't necessarily a new challenge to our industry, but it seems to be hitting a lot lately. I want to take a little bit of a different spin on this and just give everybody a better understanding of, when something like that happens, what the heck does that do to your hedged pipeline? Right? If you've got to shut everything down, how do you navigate that?
Yeah. It's funny. And I don't know if the regulators, if this was something they anticipated or something they've just been quickly reacting to, but I've had actually 2 formal reviews where they asked me about, my pipeline and the pipelines the information that we're sending to vendors and hedge consultants and that sort of thing. What kind of information is in there, and what are you sending, and how are you sending it, sort of a thing. And we've even had a sort of a model testing with our own with our own vendor, and NPI type stuff got into there as well. I think one of the things we're doing is we're reducing the amount of the NPI that goes in stuff that we really don't need. We don't need the address of the customer. I mean, maybe there's a loan ID and maybe there's a name, but out of those, tapes that we share with our vendors, we're just trying to reduce the NPI as much as possible. And then, one of the things that we're also doing to mitigate factors is we're also kind of coming up with alerts and tolerances on our, on the files that we send out, so we want to know if data looks bad or corrupted or whatever it is, whether it's someone just fat fingered a number and we have a really bad rate, or is there something where someone intentionally corrupted that data. So we're doing things to try to be proactive about it, so that way we can, when you hear about this, you think it's just an IT thing or something like that, but we're putting alerts on our files, so that way if we can, as a front line of defense, if we see anything that looks out of, just looks out of line, is this something that was just a fat finger, or is this, intentionally corrupted data? We're doing that. I think it's a good, whether it's, someone's hacking into your system, or whether that's just, someone unfortunately being, not being a little careless with their own data. It's a good way to, look at that stuff and try to identify it before it becomes a big issue.
Yeah. We do have a question in the chat from Stephen Morse. He wants to know if Premier sells servicing or retain it all and service yourself.
So we sell most of, I'm sorry, we retain most of the servicing. We sell the majority of the business to the agencies, and we retain the servicing. Government loans, we will sell servicing release. So FHA, VA, that sort of thing, we originate servicing release. But portfolio we service, and we serve this in-house. We don't outsource. And conventional loans that we sell to the agencies, we service in-house as well.
So Brooks, when the mighty they out there say, oh, servicing's worth about a point, I assume that the servicing that you retain, you have valued quarterly or once a year, and quarterly through your hedging company. You don't have to name them if you don't want to.
We have a so we have someone outside that is just sort of a separation, but yeah, I mean, another closely aligned vendor.
So when somebody says, when they say servicing is worth a point, what makes it worth a point? Why is it worth a point? If I look at a car, if I look at my 88 Corolla over there, I can go on to Blue Book, or I can, there's a market for that Corolla. Yeah. I mean, where does the value of servicing come from? Why do they say it's worth about a point?
Well, I think with the one thing, servicing values are, likely as valuable as they've ever been on the market. And I think it's just because of, the reduced prepayment risk, at least as far as the product that's out there right now that's on the balance sheet, those loans that are in the 3% and 4% range. Well, it can upset your net cost, your net interest margins. It can be profitable because it's going to stay on the books. It's going to perform. You're going to have an asset that's going to pay you, a servicing fee month after month after month. And depending on where rates are at, rates today are likely much higher than the majority of the loans that that institutions have on the book. So, we haven't really changed our servicing our servicing values that much, because it's a little bit, it's something that can go away really, really quickly. But it's just really a result of, what's on the books, how long is it going to stay for, what kind of servicing fee can you get on that sort of a thing. And right now, those servicing is as valuable as ever, actually, because of the lower prepayment risk. So, that's one thing we kind of talked a lot about prepayment risk, and how, it might create additional fallout or EPOs or that sort of thing, but at least it's pushed up servicing values. I mean, we shouldn't look at everything so negatively in this market. We need to take the good guys that we have, and servicing is one of them.
Got it.
Well, congratulations for being able to hold on to that servicing, because obviously many companies have had to sell servicing in order to support their operation.
Yeah.
And it's like selling, your mother's milk, because that is the servicing income
Yeah.
is helped keep many companies afloat. And when you sell that, it can be tough, towing ahead.
Absolutely. And we've kicked tires on it. It's not that we haven't investigated it. But we've chose to hold on to the servicing, but it's a robust market. I mean, if you're looking to, raise some capital, raise some money, that's what a lot of institutions are doing, is maybe looking at servicing, because it's the one asset that's actually, inflating right now, or you can get a good value out of.
So when you are, when you're asked, hey, unemployment's coming out Friday, should I lock today? That kind of question. Do you have a canned answer?
I always tell them, we're not a crystal, I give them the disclaimer, we're not a crystal ball, and this and that. I might throw in my own 2 cents every once in a while. I usually tend, to lock in, it's going to be a lot more painful if rates go higher and you don't lock than if, the other way around, sort of thing. So I usually recommend locking, and if we can get that loan and start working on the loan, it works out better than normal. But I'll give them at least a little bit of background, like, hey, I think rates are, if it comes in this way, I think rates could, they could move. If they come in another way, I think that's kind of built into market pricing, sort of a thing. And that's one thing that I think, whether it's customers or loan officers or whoever it might be, a lot of the times an expectation is already set into the number, so when the number comes in, if it comes in at expectations or whatever, there might be no reaction to the market. So sometimes people will ask me, they'll say, hey, we're expecting a really big jobs report. If it comes in with a really big number, do we think we're going to see rates go up or down or whatever? And I'm like, well, that big number is also already built into market expectations. So it's going to take something different than that to really move the market. So, I try to work them through that, because I think a lot of it is misinformation on what they think is going to happen if rates go with expectations. And I try to explain to them, well, if that's the expectation, it's already kind of likely built into market pricing. So we should think about what happens if it doesn't come in at expectations and what the impact might be. So we try to handle it that way, rather than, just saying, hey, I think I think rates are going to get better. I think rates are going to get worse, sort of a thing. I'm in secondary markets. My job is a hedger. So, I'm not a speculator. I'm not there to say, hey, I think rates are going to go down. Yeah. My job is to try to get the production in and cover it as much as possible. But I do try to talk them through the scenarios and what could happen in every scenario.
We've got a couple.
Yeah, your job is to keep the margin, keep the margin intact.
Exactly. Set the margin and keep it.
We got a couple good comments in the chat. Philip says, always lock today. And Steve says, can only lock on current rate, can't lock on yesterday's. The way you know what the bottom line is when it's
you can't go broke taking a profit. Are we giving out pithy sayings here today?
Yep. Right. That's right. All right. Well, we are all up on time. But Brooks, thank you so much for joining us. I loved hearing your insights, hearing about Premier Bank. Thank you guys for joining us as well. I really appreciate everybody's comments and interactions. And we look forward to seeing you guys next week. We have Ryan Atkins on from First Horizon. So we'll have lots of good things to discuss next week as well. Have a good weekend, everybody.
Thanks, Brooks. Thanks, Melissa. Bye.
Thanks, Rob. Thanks, Melissa.